I would probably suggest going long dated Dubai. Perhaps slightly further back on the curve though, maybe we'll look at Q3 dated Dubai. So you have this kind of upside in the DFLs that we're suggesting for the margins, but also it does provide a bit of protection if OPEC do come out and we see these sour barrels. Hi, welcome back to another Trading Corner. I'm joined with James this time since he's back from holiday. And you've missed, I guess, quite a move, right?
Well, I was watching it on holiday, unfortunately. Probably going to get divorced. But.
Yeah, I guess one of the shortcomings of being a trader, you can't really escape the markets. But probably quite a lot to talk about. Maybe if we start with, we have to talk about the margin, right? Should we start there?
Yeah.
So I can't remember exactly where it was about a month ago when we last spoke, but we just have this chart here. So the purple is the margin. And I mean, from kind of Feb previous highs, we're back to testing
That's the
those, right?
the prompt margin.
This is M1, yeah. So more notably, it's kind of the last week or so where we've had an enormous rally. You know, the DFL has been a part of it. That's really helped support it, which I'll go on to talk about. But maybe if we talk about the products first, do you want to start with what we're seeing?
I've been a bit surprised by how strong margins have been. So structurally, I would have thought we'd be in a period where runs are coming back and margins are coming off.
Yeah.
Diesel's been surprisingly strong in the front. So like stocks in the US look like they're almost at minimum working capacity. So like, and you're seeing that in the front heat spread, which is like super high. So at the front, disty cracks have stayed decently bid.
And this is, sorry, so the US is doing well. Is that filtering into Europe? Or is Europe its own view?
I think the strength has come from, unusually, because normally, like the US is now a big distillate exporter. So coming out of turnarounds, their production picks up and they export a lot of distillate to the rest of the world and to Europe. So that's what I was expecting to happen. And I think they probably have kept up decent exports and that's what's kept stocks low in the US. But they are extremely low, and we're kind of seeing that in pricing, and also high sulfur fuel oil has been like unbelievably strong. So like we're almost at like a positive high sulfur fuel oil crack.
Wow.
And naphtha's also been strong. So like they've all pretty much performed when I wasn't really expecting that to happen.
Sure. So it's all kind of the cracks that you're talking about here, the high sulfur fuel oil, the naphtha cracks.
This is in the prompt. I mean, the deferred's not.
Sure, but these are the cracks that are traditionally, you know, the waste products of the margin, right? They typically trade at discounts to Brent, and so they're starting to head towards flat. I mean, I'm not sure about naphtha, but that's adding more to the margin rather than
on the CDU
typically taking away.
Yeah, and what's also happened, which is interesting, is gasoline has picked back up. So actually, complex margins and like FCC margins have recovered massively. So like. The CD margin is extremely good, and the more complex, the upgrading margins are good as well. So like across the whole spectrum, it's picked up.
Okay, so is there any margin? I mean, you're talking about different types of margin here: FCC, more complex, more simple, etc. Is there any margin that's not doing well at the minute?
The only unit margin that's not as good is probably the coking margin, just because high sulfur fuel oil cracks are so high. But I was looking at it this morning, and actually it surprisingly still looks all right. I think. Partly is like naphtha and gasoline are doing so well, and disty's all right. The coking margin's still there.
Yeah.
Possibly.
Okay, and then you just also said that it's mostly in the prompt. So how prompt are we talking? Are we talking about, you know, the pricing spread and maybe the next month, or is it a little bit further?
For disty, the cracks are doing well right at the front, and actually, even though we've seen a lot of on the dips in flat price, you get a lot of like airline buying coming in and like buying deferred distillate, which in theory strong at the front and buying at the back should have been supported the back cracks, but actually that's not happened as much. So like deferred cracks have kind of stayed where they are, if not come off a tiny bit. So I think it's just purely something at the front.
Okay, interesting. So I mean, you know, classic refinery economics, all of this strength in the cracks should filter through to crude, but that is the absolute opposite of what we're seeing, right? So yeah, maybe if we just rewind 2 weeks when we last did this segment, we were kind of suggesting that crude was probably topping out. And there wasn't too much of a risk reward to really push into the crude contracts, which is why we suggested going long the gasoline cracks. It was really supporting the margin. I mean, since then the margins I think gained another $2, and I think a lot of that has to do with the light space. So that performed well, but what I really didn't anticipate was how much weakness we were going to do in crude. So for the last couple of weeks, we've had a bit of a battle in positioning for dated Brent especially. Last week, I think we had around 13 or 14 physical cargoes trade in the window in the first maybe 3 days, which is a huge volume, to be honest. It's quite unusual.
Was that before the Spain outages?
Yes, okay. So I think the Spain outage was this Monday. So this was a week before that. So Monday, Tuesday, Wednesday last week, we saw, a number of transactions, predominantly on TI Midland, which, to be frank, it made sense. The US, they lag their maintenance schedules. So they were I think only this week they're really starting to come out of maintenance. So they did have some cargoes that could get booked into Europe and Asia, etc. So it wasn't too surprising that there were some cargoes that were transacting on the higher DFLs than dated. But I think the number that were offered into the market probably took some people by surprise. So we had one or two but more bullish counterparts that were, pricing out long and taking these cargoes. So apparently they fixed these cargoes into the east. So it's likely that they just did a bit of switching, 40s for TI or something similar. So perhaps they haven't had to, take the cargoes onto their book. But even so, I think the market was caught off guard. You take that, couple it with the Spain power outages we saw this Monday, and there are heavy rumours now that OPEC are going to start increasing production, really rapidly. The crude market has, it's just totally dwindled away. I mean, it's quite alarming how, with such strong margins, especially in the prompts, maybe we can look at some of the more deferred ones, but for June loading cargoes, essentially, the margins are doing particularly well. And it looks like there's just very little demand for crude around. I think similar to you, from your lens, I guess you're saying the margins look so high. From my lens, the crude versus the margin, or crude generally looks cheap.
And when you say cheap, is that cheap relative to the last couple of years? Or, if you chart that up, is it cheap versus... I'm just wondering if we're moving back into an environment where crude, that we had outside of the last kind of 3 years, where potentially crude was better supplied. Do Brent spreads just moving back into a more normal range? And are we do we think they're low just because we're perceiving it in the last kind of 3 years type?
For sure there's an element of it, but also, it's more relative to a margin. If a refiner can get $8 out of a cargo, that's very bullish, and you'd expect that to come into some structure, come into the physical pricing of these cargoes, but actually the prompt. So it's kind of two-tailed. So with the Spain and OPEC news, the whole curve has been sold into. So dated versus anything else, apart from Dubai, but dated versus, let's say, Brent spreads, TI spreads, even all the products, etc. It has come off relatively down the whole curve. Quite a lot, to be honest, very encouragingly. So that makes sense because the sentiment is that we're going to get more production out of OPEC into, from let's potentially say June into forever. So it is right that the whole curve should go. But what we actually have in the prompt in dated as well is there's one cargo, maybe there will be more than one. There's one cargo for May loading, which is just not clearing. And so it's led to one counterpart offering down this cargo each session to really low diffs. I think it's probably getting close to flat to dated. It's a Midland cargo. Flat to dated or potentially even into a negative territory now. For May loading, which is when, all the refiners should be back out. They're looking at these margins, etc. But it looks like everyone's just holding back and waiting to see what OPEC are going to say on Monday. But either way, this OPEC news shouldn't really be impacting the prompt as much as it has done in dated. That's the main thing going on here. And if we do look forward and we go back into this regime of lower Brent spreads, lower dated diffs, etc. We haven't even started talking about Brent SPY yet, but we need to see the margin also come off as well, because
I don't think that will happen yet. So I mean, if we do have a scenario where OPEC is increasing production, I think we'll need to kind of process that crude. So potentially you could even see margins maybe go up further in the front, because it needs to incentivize marginal refinery capacity to kind of come back online.
Well, that is the thing. You do need to look at how the refineries are actually utilising their space or capacity at the minute anyway, because OPEC coming out with this production when all the refiners are at 100% capacity is very different to OPEC coming out when they're all at 60 to 70%. That means there's spare capacity in the market. So theoretically, those barrels can be absorbed. Whereas if they're more towards 100%, 95, 100%, it's unlikely that their crude is going to get absorbed. And so therefore the structure, the flat price, etc., that should have to absorb all that additional capacity. So yeah, it's definitely a balancing act, and you have a lot of these lead lags occurring as well. As we said, given the seasonally the time of year, we're seeing these products rally and the crude come off. It is unusual because it should be the end of maintenance season, but it's just once you start trading psychologies, etc. As I just said with these cargoes that are getting offered down, it's more the sentiment. No one wants to buy the cargo yet. They probably will at some point, and when they do, I'm sure they'll be glad they did it, but they need some more information first about what's going to happen to OPEC. So we're definitely in a kind of tentative time. It's to be honest, it's been quite tricky to trade. I think, you look at production numbers and especially the stocks we're saying in the products, etc. You would think that the market should be on a bit more of a bull run, but maybe we've just already had it. It was a few weeks ago, and that's it. And now we're into a new regime.
Yeah, hard to know. I mean, personally, I guess I'm kind of doubling down on my my view, but I still think we should be heading into a tighter crude scenario as we head into summer and runs come back. And personally, I think simple margins look too high to me. So yeah, I'm for now. I'm kind of sticking.
So that's a
with
classic 3-2-1 spread, crack spread, right?
No, that would include gasoline if it's like a classic one. But I'm personally kind of, it's moved up a lot, so I'm not still sure I'm bullish gasoline here, because FCC margins have come back. So the whole argument for being long
gasoline, it's kind of been eroded. Right?
I think it's been eroded a lot. So I'd probably stick with just a general margin, distillate about 50% diesel and jet fuel, then maybe 20% gasoline, 15% naphtha, 15% fuel oil.
Okay. Shorting this against.
Yeah, I mean, again, it's not something I have on my books. It's not a high conviction view, but personally, I think it should be pressured over summer. So I mean, I'm not even that convicted that I'd kind of give it as a trade view, but personally, I think it will come off though. But I mean, I think there are other super interesting things at the moment though. So Brent spreads have come off a lot, as you mentioned, and that's pressured the product spreads. So particularly ones like gasoline spreads and deferred spreads, say from Deck 25, have been hit hard and look extremely cheap on the chart. So you've got a lot of decent buying on those spreads at these levels. So what it's created is extremely strong deferred crack boxes on things like EBOB. Yeah. Which is quite interesting because it makes the even more deferred EBOB cracks extremely cheap, because you've got very decent buying on the spreads.
So this is Cal 26 you're looking at?
Say Cal 26 EBOB, or even further out Deck 26 EBOB cracks are extremely low. So if I was mentioning a trade view, it'd probably be looking at some of those.
Okay.
Just because understandably people are buying the spreads because they're cheap. I think it's all just been created by this quite significant move down on Brent.
Yeah, I mean, well, maybe let's talk about that a little bit more. It wasn't as though there was a big headline. I think it was the first time we heard of OPEC coming out with an extra 400 KBD. It was back in early April, I think. And it just feels like slowly over the course of the weekend and the last couple of days, kind of the physical space, especially the funds actually, we've seen a lot of fund selling, but the physical space is kind of hearing rumours of increasing production. So no news outlet has come out with any news regarding OPEC and any increase in production. So it very much is still a rumour mill at the minute, but the whole market has bought into it. I mean, yes, Brent spreads is one thing, but Brent to buyers,
it's hard though, like when you say the whole market's bought into it, like I always feel a bit that versus particularly like the physical guys or like better connected, like politically hedge funds and stuff, we kind of informationally had a bit of a back foot. But like just looking at the way the market's pricing, it feels like it's going to be an increase in production.
Oh yeah, 100%. But exactly. I mean, we can't have had this much of a price, reset, and as I was saying, nothing's been in the news. OPEC haven't made any official statements without it being true. I just don't think that the market would sell so willingly, given where the margins are, given the time of the year, if they weren't, sure that this was going to happen. So it very much feels like, yes, we are.
It's interesting how much is priced then. Like on Brent Spencer, I don't know.
Where do we stop? Exactly. I actually really
But is
agree.
it priced already or not? And if everyone's then expecting the headline.
Yeah. That's the thing, and as I was just saying, I've seen a lot of funds selling. So the fact that that's kind of the excess cash that you have in the market. So when we do have these headlines, maybe when they come out and confirm it, perhaps we won't see so much of a price action because it's already priced in. But just quickly to talk about Brent to buy, really Brent to buy is where we first saw indications of it. So we were towards the end of last week, we were hearing kind of rumours that, so I think maybe for the last 2 years, Brent to buy has been very much a short market. So everyone has been long to buy spreads, the back of Russia, Ukraine, etc. Just all the sour barrels are out, and obviously OPEC. So more often than not, the trade houses and everyone has been long to buy spreads into pricing. And towards the beginning of the year, you were feeling it was running out of a bit of momentum. Perhaps there was a little bit less conviction. We've had rumours of OPEC increasing production for a long, long time, but it hadn't materialised into anything until about 2 months ago, where it was really difficult for a couple of the guys to really push up these pricing spreads. They're just getting sold into really easily. So that was kind of the first sign of it. And then the last 2 weeks, I would say, we've slowly started to see trade houses starting to kind of buy back their Brent to buy positioning. Perhaps they're covering their shorts, but it does feel like the market is slowly getting long as well. I wouldn't say they're totally out of the shorts, given the price action we're still seeing. So I think from last Thursday, we've rallied from minus 130 on the front up to flat. So it's an enormous move on a Brent to buy contract. But it's also very volatile. You can feel that actually the correlation, for example, with Brent is really high.
It's interesting it's happened as well. So Brent to buy has moved up with high sulfur fuel oil cracks moving up massively as well, which normally you'd expect the opposite.
Exactly. So Dubai has been for sure sold into. I mean, this month's pricing wasn't particularly, impressive either. So perhaps people are just losing a lot of, I don't know, a lot of.
I guess if you think OPEC's about to ramp up production, then yeah, you'd sell the conviction.
Yeah, conviction. There we go. Yeah, but I guess the point of Dubai and why it's always so it's one of those markets where kind of everyone can position the same way and still do okay. So it means when they flip their position and they go from being short Brent to buy to long Brent to buy, you do tend to see these really big flushes in price action. So I think that's probably what we're going through now. So we might be in a totally different regime next month, and maybe we start pricing short and to buy. But yeah, very much kind of still under the umbrella of everything that's happening with OPEC. But the volatility is still there, same with Brent. So yeah, super interesting time. I mean, going forward, yeah, exactly. The few things now are, is everything priced in? Have we overcorrected slightly, perhaps on Brent, given where the rest of the barrel is?
Yeah, it's going to be a super interesting couple of weeks.
I think given the structure on dated, it's always about risk reward, right? Would you rather go short or long here? I personally would rather go long on Brent here.
But it's also your timing, because like
especially.
all these, it's been so volatile. All these views, like even within a week, like or sometimes within a day, like
Yeah.
you'll go from the highs to lows, or so.
No, it's true, and also the state of the moves. A 50-cent spread sell-off totally changes the dynamics of the market, and same with the crack rallies. So yeah, you have to be responsive for sure, but I guess it's just not a great time for huge positioning, right?
I think that's exactly right. So like, I think this is the time to be fairly nimble.
Yeah.
And trying to kind of chop the ranges rather than being too big and basically being stopped out and chopping yourself out at the worst possible pricing. But
Yeah.
So agree. Yeah, small
Positioning. Okay. Well, yeah, a lot to think about, but maybe if we just suggest one or two trades. I guess yours is more in the back.
So I really like deferred gasoline cracks. Like, I mean, it's quite niche and super far out, but like Deck 26. I mean, if you can buy it below $3 a barrel, I mean, I think it's pretty decent risk reward. It's just a long-term portfolio trade.
Sure. And for us, I think I would probably suggest going long dated Dubai. Perhaps slightly further back on the curve though. Maybe we'll look at Q3 dated Dubai. So you have this kind of upside in the DFLs that we're suggesting for the margins, but also it does provide a bit of protection if OPEC do come out and we see these sour barrels hitting the market. An alternative is to go long Brent Dubai, but yeah, for me, the expression would be long Q3 dated Dubai.
Cool.
Okay, we'll see where we are in a couple of weeks.
Thanks.
Thanks.